Welcome, everyone, to another crucial installment of Updates with John. Today, we're diving into a financial saga that's as dramatic as it is perplexing. A story that saw silver, a metal often overlooked, reach an unprecedented peak. On January 29, 2026, silver touched an astonishing $121.62 an ounce. This wasn't just a new high, it was the highest price silver had ever commanded in the entire recorded history of money, surpassing even the legendary peaks of 1980 and 2011. Yet, within a mere 24 hours, this monumental achievement was followed by a staggering reversal. The metal lost nearly a third of its value in a single trading session. This wasn't triggered by a global conflict, nor by the collapse of a major mine, nor by a sudden evaporation of demand. Instead, this dramatic downturn was initiated by a single exchange, through a single announcement, altering a single number on a margin sheet. As we speak, silver is trading in the vicinity of $62 to $66 an ounce, representing a decline of almost 50% from that historic zenith. However, it's crucial to note that despite this pullback, the metal is still up by nearly 80% compared to its value a year ago. This brings us to a pivotal question, one that few in mainstream financial media seem willing to address head-on. Was that precipitous crash an unfortunate accident, or was it a meticulously orchestrated, controlled demolition? Stay with me, because by the end of this discussion, you'll begin to discern a striking pattern connecting the events of 1980, 2011, and 2026, along with a remarkable coincidence involving one of the most influential bankers in the world, a detail that even many seasoned analysts failed to connect until weeks after the fact. Let's consider a number that should truly give you pause. In July 2025, silver was trading at approximately $38 an ounce. At that price, it was largely an afterthought in the financial world, a metal primarily used by jewelers, a mere line item in the production cost of a solar panel. Fast forward just 11 months, and its value had tripled. This isn't a typical commodity movement. This is the kind of explosive surge that occurs perhaps once or twice in a lifetime. And here's another critical point that almost no one is discussing. This extraordinary rise in silver's value is unfolding precisely as the institution responsible for controlling the price of money in America undergoes a leadership change for the first time in 8 years. This transition, moreover, was marked by one of the most contentious votes for that position in history. Keep that thought in mind. We'll circle back to it. When adjusted for today's inflation, silver has yet to reclaim its inflation-adjusted peaks of 1980 or 2011. This means that, depending on whose perspective you adopt, silver is either wildly overbought and due for a significant correction, or it's merely at the nascent stages of a much larger rally. Both of these diametrically opposed viewpoints are being passionately argued by individuals and institutions with substantial financial interests backing their opinions. And here's the aspect that should genuinely unsettle you. This isn't the first instance where silver has surged to a record high, only to be abruptly undermined within days by a sudden, unexpected rule change originating from the very exchange responsible for pricing it. It happened in 1980, it happened again in 2011, and it has just happened once more. 3 distinct rallies, 3 record highs, and 3 times the same playbook has been deployed. Each time, the same justification is offered: routine risk management. We are going to meticulously examine what this phrase truly entails, who ultimately benefits from such interventions, and why some of the most astute minds in this market believe it holds the key to understanding everything that lies ahead. But first, let's reconstruct the events that transpired between January and June, because the official narrative and the complete story are often 2 very different things. Before we delve deeper, a quick thought experiment for all of you watching. Take a moment and drop a number in the comments section below. Where do you anticipate silver will be trading by December of this year? Do you foresee it at $45, perhaps $90, or even an astonishing $150? Later in this discussion, I'm going to present you with forecasts spanning this entire range, originating from highly reputable institutions, and the sheer divergence in their predictions might surprise you. If you find this kind of in-depth analysis valuable, please hit that subscribe button now. The next 10 minutes are where this narrative truly takes a turn into the genuinely strange. Let's meticulously reconstruct the timeline, because the sheer speed of these events is a story in itself. By December 2025, silver had already experienced an approximate 150% gain for the year, marking its most impressive performance since 1979, the year it famously spiked by nearly 470% during the infamous Hunt Brothers saga. Remember that name, it will become relevant again. However, in October 2025, something far more subtle yet ultimately more significant was unfolding beneath the surface, largely unnoticed by the mainstream headlines: lease rates. The cost of borrowing physical silver in London began to spike dramatically, soaring towards an astonishing 40%. In normal, healthy markets, these rates typically hover in the low single digits. A 40% lease rate is the market screaming unequivocally that real, physical metal is becoming almost impossible to locate. Then, in the first 2 weeks of January 2026, an astounding quantity of silver, more than 33 million ounces, was physically withdrawn from COMEX vaults in New York. This represented approximately a quarter of the exchange's registered inventory, vanishing in a matter of days. It was a clear signal that market participants were no longer content with paper promises. They desired tangible metal in their hands. On January 29th, silver reached its zenith at $121.62. What transpired next sent shockwaves through analysts who had been forecasting a steady, continued ascent. The very next day, the CME Group, the parent company that operates COMEX, announced a significant increase in margin requirements for silver futures contracts. Within hours, highly leveraged traders who had purchased silver with borrowed capital found themselves facing margin calls they simply could not meet. This triggered a cascading wave of forced selling. Silver plummeted by 30% to 35% in a single session, marking its sharpest one-day decline since 1980. The descent continued for an entire week, eventually bottoming out near $64 by February 6th. This represented a breathtaking 47% collapse from its peak to its trough in just 8 trading days. But here's the detail that should truly make you pay attention. In the very same week that silver was experiencing this dramatic cratering, something else of immense significance was unfolding in Washington, D.C., an event that almost nobody connected to the silver market at the time. It involved the individual who would soon occupy the single most powerful chair in American finance. We're not quite there yet, but hold that thought. First, let's understand why silver exploded in the first place, because the bullish case for this metal is far more fundamentally grounded than the chart's recent volatility might suggest. If you're finding this analysis useful, now is the perfect moment to hit that like button. It genuinely helps this crucial information reach more people who are striving to understand what's truly happening to their money, rather than simply reacting to sensational headlines. Now, let's talk about the deficit, the one that no one in the mainstream press seems willing to put on a chart. Here's a number that, frankly, should be emblazoned across every financial front page, yet somehow remains largely unacknowledged. The year 2026 marks the 6th consecutive year that the world has consumed more silver than it has managed to mine and recycle combined. 6 straight years. This isn't a fleeting blip on the radar. This is a deeply entrenched trend. According to the authoritative data from the Silver Institute and Metals Focus, the projected shortfall for 2026 is estimated to be around 46 million ounces, which is approximately 15% wider than the deficit recorded in 2025. Since 2021, the global economy has had to draw down an astonishing 760 to 820 million ounces from existing above-ground stockpiles simply to meet demand. To put that into perspective, that's nearly a full year's worth of global mine production quietly vanishing from vaults and storage facilities. The real story here isn't merely the fluctuating price. The real story is that the world has been systematically depleting its silver savings account for 6 consecutive years, and almost no one took significant notice until the price chart began its vertical ascent. Then, in October 2025, China dramatically escalated the stakes. Beijing officially reclassified silver, elevating its status from an ordinary commodity to a strategic material, placing it in the same critical category as rare earth elements. New export regulations subsequently took effect on January 1, 2026, reportedly restricting 60% to 70% of exportable silver to a very limited list of approved firms. And it's vital to remember that China refines approximately 70% of the world's traded silver. When the largest refining hub on the planet begins to tighten the tap on supply, the ripple effects are felt across every nation that relies on Chinese metal, from American solar panel manufacturers to European electronics companies. Elon Musk publicly voiced his concerns about this move, warning that silver is absolutely essential to countless industrial processes. He wasn't wrong. But the crucial layer that most media coverage missed was that this action mirrored almost precisely the playbook China had already executed with rare earths, tungsten, and antimony, using control over critical materials as a potent form of geopolitical leverage. Silver had just been added to that exclusive list. So what we have is a confluence of powerful forces: a 6-year structural deficit, a major exporter deliberately curtailing supply precisely as that deficit was widening, and surging industrial demand from sectors like solar, electric vehicles, AI data centers, and a renewed interest in nuclear energy, all fiercely competing for the same shrinking pool of available silver. However, most investors overlook the next critical piece of information, and it's a vital one. At prices exceeding $100 an ounce, solar manufacturers began actively engineering silver out of their panels, thinning the silver paste in an effort to protect their profit margins. High prices don't merely reflect scarcity, they actively trigger behavioral changes designed to alleviate that scarcity. This is one of the strongest bearish arguments in this entire narrative, and we'll need to revisit it later. Scarcity undoubtedly explains a significant portion of the price climb. The other part of the story, however, is far stranger, and it involves an exchange that possesses the extraordinary power to unilaterally end a rally with a single phone call. This is where this stops being a normal commodity story. The CME Group, the powerful entity that owns and operates COMEX, possesses a tool that almost no retail investor truly comprehends. It has the authority to raise the margin requirements on a contract whenever it determines that market volatility has become too extreme. This action immediately forces every leveraged trader to either deposit additional cash into their accounts without delay or face liquidation of their positions. The CME characterizes this as standard risk management, a normal course of business undertaken to safeguard the system from the kind of cascading defaults that could bring down brokerages and banks. And, to be fair, this isn't entirely false. Exchanges exist precisely to prevent the type of catastrophic blow-ups that can destabilize the financial system. However, this is where the narrative takes a peculiar turn. Let's examine what historically transpires every single time silver experiences a parabolic surge. In April 2011, silver was rocketing towards $50 an ounce, its highest level since 1980. This rally was fueled by the lingering aftermath of the U.S. debt ceiling crisis and a flood of speculative money entering the market. As it approached that critical level, the CME aggressively raised margin requirements on silver futures multiple times within a matter of days. Then, in the early hours of May 2nd, news broke that Osama bin Laden had been killed. Leveraged long positions, already stretched thin by the preceding margin hikes, were unable to withstand the shock, triggering a torrent of selling. Silver plummeted from approximately $48 to $33 in just 5 trading sessions, marking its most significant 3-day plunge in 28 years. Now, let's rewind further to March 27, 1980, a day famously known as Silver Thursday. The Hunt brothers, Texas oil billionaires, had spent years meticulously accumulating what was estimated to be a third of the world's tradable silver supply, driven by their conviction that it represented the ultimate hedge against a collapsing dollar. As their position grew to a size that threatened the very stability of the exchange itself, COMEX abruptly introduced Silver Rule 7, a sudden and severe restriction on purchasing silver with borrowed money. The credit lifeline fueling the Hunt's massive position evaporated overnight. Margin calls began to pile up. On March 27th, they defaulted on a $100 million margin call they couldn't meet. Silver crashed by approximately 50% in a single day, falling from around $21 to under $11. Transforming a $7 billion paper fortune into a $1.7 billion debt within weeks. 3 distinct rallies, 3 record highs, and 3 sudden interventions involving margin rule changes from the exchange itself. This isn't a mere coincidence that can be easily dismissed. However, it's also not, in isolation, definitive proof of a conspiracy, because raising margins during periods of extreme volatility is precisely what a responsible exchange is supposed to do. Both of these seemingly contradictory statements can, in fact, be true simultaneously. The uncomfortable truth, however, is that the effect, every single time, conveniently favors whoever was holding a short position in the metal. And silver has a well-documented history of individuals and institutions deliberately engaging in such shorting activities. In September 2020, J.P. Morgan Chase agreed to pay a staggering $920 million, at the time, the largest penalty in the history of U.S. derivatives regulation, to settle charges that traders on its precious metals desk had spent at least 8 years placing tens of thousands of fake, or spoof, orders to deceive other traders in both gold and silver futures markets. Individual traders involved in the scheme pleaded guilty. This wasn't a rumor. It's a matter of public record with the Department of Justice. So when someone tells you that the silver market has never been manipulated, that statement is simply untrue. There's a clear paper trail, complete with a 9-figure fine, to prove otherwise. The open question, then, is whether the events of January 30th, 2026 belong in that same category of deliberate intervention, or whether they represent something far more mundane. But here's where the narrative takes a strange turn in an entirely different direction. Because in that very same week, just 400 miles from the COMEX trading floor, something else was unfolding that would fundamentally reshape every assumption silver investors were making. Let's be brutally honest about something here. It's incredibly tempting at this juncture to neatly tie everything up with a bow, to conclude that the exchange crashes the price 3 times over 45 years, always right after record highs, always benefiting those who are short the metal. Case closed. It's rigged. Except the data doesn't allow us to stop there. Because every single one of those 3 crashes, the price eventually recovered. After the 1980 crash, silver eventually pushed towards new highs in 2011. After 2011, it took 14 years, but silver ultimately shattered that ceiling in 2025 and 2026. And crucially, after the January 2026 crash, silver didn't stay down. It clawed its way back to nearly $90 by March, even as the underlying structural deficit continued to widen. If this were simply a rigged market, meticulously designed to suppress silver prices indefinitely, that kind of recovery simply wouldn't make sense. A market that consistently recovers and retests new highs looks less like permanent suppression and more like a highly volatile, leveraged asset behaving precisely as such assets always do, overshooting, being disciplined by margin rules, and then resuming its underlying trend once the speculative froth has been washed out. That's the more mundane, structurally bullish explanation, and it might very well be the correct one. However, you cannot fully evaluate this explanation without understanding what was simultaneously transpiring at the very pinnacle of the U.S. financial system during that exact window. Because the precise timing of one particular event, when juxtaposed against the calendar, is the kind of detail that even seasoned professionals failed to connect until after the fact. Here it is, for your consideration. On January 30th, 2026, the very same day that the CME's margin hike triggered silver's most severe one-day crash since 1980, President Trump publicly announced his selection for the next chair of the Federal Reserve, a man named Kevin Warsh. 2 of the most consequential events in global finance that month, landing on the exact same calendar day. One unfolding in a futures trading pit in Chicago, the other in the hallowed halls of the White House. Nobody planned that collision. There is absolutely no evidence to suggest that the 2 events were coordinated. Yet, the coincidence is undeniably real. It is verifiable. And it is precisely the kind of detail that fuels every controlled narrative and conspiracy theory. Because for the subsequent 4.5 months, the fate of silver and the direction of U.S. monetary policy became inextricably linked, almost impossible to separate. To truly comprehend where silver is headed from this point forward, you must first understand the individual who is now occupying the most powerful chair in global finance. Kevin Warsh is not a newcomer to the Federal Reserve. He previously served as a governor from 2006 to 2011, meaning he was present in the room during the tumultuous 2008 financial crisis, actively participating in shaping the trillion-dollar emergency response. Following his tenure, he spent over a decade as one of the most vocal public critics of the very institution he once helped to run. In January 2026, the same month silver reached its peak and subsequently crashed, President Trump nominated Warsh to succeed Jerome Powell. Trump had, for over a year, publicly attacked Powell for not pursuing a sufficiently aggressive policy of interest rate cuts. The confirmation battle that ensued was arguably the most openly partisan in the Federal Reserve's history. A key Republican senator initially blocked Warsh's nomination for months. However, on May 13th, the Senate ultimately confirmed him by a vote of 54 to 45, marking the narrowest margin ever recorded for the position. Here's the layer that almost no one anticipated. Trump had campaigned for years to install a Fed chair who would rapidly cut interest rates. Markets, and indeed most retail silver investors, operated under the assumption that Warsh's appointment would usher in an era of cheaper money, a weaker dollar, and thus rocket fuel for precious metals. What transpired next shocked analysts on both sides of the political and economic spectrum. Warsh's very first meeting as chair, held on June 16th and 17th, resulted in the Federal Reserve holding interest rates steady and, surprisingly, adopting a notably hawkish tone. 9 of the Fed's 19 policymakers signaled that they now anticipate at least one more rate hike this year, a stark contrast to the expected cuts. Markets immediately began pricing in the possibility of a rate increase as early as September. The man whom Trump had appointed with the expectation of easing monetary policy did almost the exact opposite. This was because, by June, a separate and pressing crisis had completely overtaken the inflation conversation. A confrontation between the United States and Iran, which commenced on February 28th, sent oil prices soaring above $100 a barrel, reigniting precisely the kind of inflation fears that make central bankers hesitant to cut rates. The real story here isn't merely silver sitting at $62 an ounce. The real story is that the single most important rate decision maker on the planet changed hands in the midst of silver's most violent 6-month period in modern history. And his very first move directly contradicted the expectations of both the market and the president who appointed him. Generally speaking, higher interest rates for a longer duration tend to strengthen the dollar and diminish the appetite for non-yielding assets like silver. So, the critical question becomes, which force will ultimately prevail? The deficit-driven bullish case for silver, or the hawkish Federal Reserve's bearish stance? To answer that, we need to examine how similar scenarios have played out historically. Because this isn't the first time a Federal Reserve regime change has collided with a precious metals mania. Let's revisit 1981 one more time, because the parallels are almost uncomfortably precise. The Hunt brothers' silver mania unfolded against a backdrop of double-digit inflation and a Federal Reserve under the newly appointed chairman, Paul Volcker. Volcker was about to declare an all-out war on rising prices through a series of brutal interest rate hikes. Volcker's aggressive tightening policies, coupled with quiet pressure on banks to cease lending for speculative silver purchases, helped accelerate the crash that culminated in Silver Thursday. Here we have a new, aggressive Fed chair arriving precisely as a precious metals bubble reached its peak. The parallel to 2026 writes itself. Now, picture 2011. Silver was once again climbing towards $50, fueled by the lingering hangover from the 2008 financial crisis, a massive influx of stimulus through quantitative easing, and a contentious debt ceiling standoff that led investors to question the safety of government bonds. Then, Chairman Bernanke's decision to pause additional stimulus helped trigger the subsequent unwind. Retail traders who had bought near the top, convinced that silver would smash through $50, watched their accounts get liquidated within days as margin calls outran their ability to respond. In both instances, the pattern was strikingly identical. A parabolic rally, fueled partly by genuine monetary anxiety and significantly accelerated by leverage, followed by a regulatory or central bank intervention that violently ended the party, and then years of consolidation before the next upward leg. Here's the detail that should concern both bulls and bears alike. In real, inflation-adjusted terms, silver has yet to surpass its historical peaks. This means that while the nominal price may hit new highs, its purchasing power might not have reached the same levels as in previous eras. This distinction is crucial for long-term investors. The narrative of silver is complex, intertwined with market mechanics, geopolitical strategy, and the actions of powerful financial institutions. Understanding these layers is essential for anyone trying to make sense of its volatile journey. And here at Updates with John, we're committed to unraveling these complexities for you, providing the context you need to navigate these turbulent waters. Stay tuned, because this story is far from over. So what does this intricate dance of market forces, regulatory interventions, and geopolitical shifts ultimately mean for you, the viewer, and for the future of silver? It means that the silver market is not a simple, predictable entity. It is a dynamic arena where fundamental supply and demand collide with powerful financial leverage and strategic maneuvers. The historical patterns we've observed, parabolic rallies followed by sharp corrections triggered by margin adjustments, are not random occurrences. They are part of a recurring cycle that has shaped silver's trajectory for decades. Understanding these cycles, recognizing the interplay between physical scarcity and paper market dynamics, is paramount. It's about looking beyond the daily price fluctuations and grasping the deeper forces at play. Here at Updates with John, our mission is to equip you with this understanding, to cut through the noise and provide you with the insights that truly matter. We believe that an informed investor is an empowered investor. The story of silver is far from over. In fact, it feels like it's just getting started. The tension between its critical industrial demand and the financial mechanisms that govern its price will continue to be a defining feature of this market. We will keep tracking these developments, bringing you the most relevant analysis and context. Thank you for joining us for this deep dive. Stay curious, stay informed, and we'll see you next time on Updates with John.